All right, hello and welcome to the first installment of Chapter 7 for this video format lesson that I'm entirely unfamiliar with and yet beginning to get the handle of. I've done some practice videos that were dicey. Hopefully this one will be less so. Anyways, Chapter 7, the main focus of this chapter is cash, but really the main focus that you will become aware of shortly is actually internal controls. But before we delve into that arena, let's just start out with some of the basics here. Which, as you can see right there, is the type of cash accounts that you may encounter when you're dealing with cash. So the first and most obvious one is cash, which in this case is really cash in bank. We're just, recognizing the reality here. You don't keep your cash in a business in a safe or a safe deposit box on the premises or a mattress or anything stupid like that. You put it in a bank. Now, what is the downside of giving your cash to a bank? Well, now because you are accounting for the cash and so is the bank, two entities accounting for the same thing means you're going to have to do a bank reconciliation every month to reconcile the discrepancy. In other words, to figure out what the true cash balance is. That's your journey with the bank reconciliation. Another account you might encounter would be the change fund. This is just saying the cash is not in the bank, it's on the premises, and it's being used for cash registers. So this is if you have brick and mortar stores operating, you'll have to have cash on the premises. And again, the cash register is a form of internal control. I'll talk more about later on in the I can't say the handout really, it's just in some other video that you'll see. And of course, the thing you'll have to deal with, because you'll have what the register says should be in there versus the cash count itself, is you'll have to institute an account called Cash Short and Over, which is a temporary account to plug those discrepancies between, again, cash collected versus what the tape's telling you. And then the other account you might encounter is what we call petty cash. Again, it's saying cash is on the premises. In this case, it would be cash usually in like a lockbox of some sort. I'll elaborate that one later on when we get to that subject. And again, it's just a way of taking care of small incidental expenses, and you just pay it out of that petty cash fund, as opposed to what? As opposed to going through something called a voucher system, which will be addressed again in another video. What we've seen is in practice, you don't see petty cash as much as you used to. It's kind of fallen out of vogue because a lot of times companies just do expense reimbursements, which just simply means you file an expense report and they reimburse you. So that's how it's handled in a lot of situations. Right, first up is the bank reconciliations. Now, if you have a checking account, you should already be doing this fundamentally. So some of these concepts, if you're doing that, should seem like, oh, I'm already familiar with that, so it's no big deal. In any case, this is probably one of the most difficult aspects of the whole chapter per se, or maybe not. So you might have a different opinion on that by the end of all these videos. Again, what are you doing here? You're trying to figure out what's your true cash balance, because the true cash balance is not what the bank is telling you on a bank statement that's usually get at the end of the month, and your ledger account also not accurate. They're both wrong. There's a correct amount somewhere between those two numbers, and you're going to figure it out. Now, again, alternately, what can this reconciliation also do? It can detect illicit activities, such as any unauthorized withdrawals, inconsistencies between booked and actual deposits. Again, this is more about the internal controls here. What we're trying to do is make sure that we're safeguarding our cash. So this should be prepared once per month by an employee who cannot authorize cash payments or journalize cash transactions. So again, big, cannot authorize cash payments or journalize cash transactions. In other words, it's got to be somebody who doesn't have their hands in either one of those. Again, that's a concept we'll talk about later, something called separation of duties. Here's your two basic formulas for the reconciliation. Up first is we're going to take the balance per the bank statement. In other words, that bank statement that you could once upon a time get mailed to you, or the bank statement that you can look up online now. That balance you'll look at there at the end of the month, which will be the last day of a month typically, that's the unadjusted balance. That's what the bank, according to their records, says your balance is. Now, two adjustments to this. We'll adjust for deposits in transit. These are deposits that you've added to your cash balance, haven't reached the bank yet, excuse me, because of a lag. We'll see how that might occur in a moment. So we'll add those to bring the bank up to date. We will subtract outstanding checks. These are checks drawn on the account by you. You've subtracted them, your business. Haven't cleared the bank yet. And then I throw into the mix plus or minus errors, although this is probably not going to be a major concern. Banks are very, they're sticklers for making sure that that balance at the end of each day checks down, everything is fine. So you're usually not going to have a lot of bank errors. After taking all that into account, you'll have the adjusted balance per the bank statement. Second formula is the unadjusted balance per the ledgers. In other words, this is what your books tell you. You look at your ledger balance for cash at the end of the month. And again, this will not match whatever the bank statement amount was. So again, what are some items that have should be added to the balance but have not been because you weren't aware of them? Again, this is where the bank statement comes into play. Look at the bank statement, and you'll look for credit memorandums. Remember, your bank balance is a demand deposit. Going back to that concept discussed much earlier on back in chapter, which one was that? Oh yeah, right, when we talk about the debits and credits chapter. So that would have to be chapter number 3. So going back to that chapter is the notion that you're a demand deposit. So again, they're still giving you the liability accounting. So in other words, the credit means their liability is going up. In other words, they've collected some money or added some money to your account that you weren't aware of, so you have to add that to bring your balance up. Other one is debit memorandums. Again, debiting the liability reduces their liability, so they're saying you have less cash in the account. Also be informing you of that. And here's the big one, plus or minus errors made by your company. Yeah, that's going to be a problem. That's going to be your biggest area of potential error is going to be right there. So once you've ironed all this out, you will get the adjusted balance per the ledger. Now, again, here's the caveat. If completed properly and without the presence of theft, and that's a big one, the adjusted balances should equal one another. That's what you're hoping for. So again, the bank reconciliation will eventually serve as a source document for select month-end adjusting entries, which we'll talk more about later. And we'll continue the example in the next video.